So, we have discussed certain concepts related to the options and the futures. We have seen that the option premium has two components, one is your time value and other one is the intrinsic value, and the intrinsic value is nothing but the difference between the market value of the underlying asset on that day and as well as the strike price. Today we will be discussing in this session we will be discussing certain models which are used for pricing this derivatives instruments. We can start with the pricing of the futures or the forwards, then we can move into the pricing of the options in the upcoming sessions. That whenever we talk about the pricing, one model always used for pricing of the futures, that is basically we call it the carry pricing model. What do we mean by the carry pricing model? In a very simplistic way, the carry pricing model is nothing but the spot price plus the carry cost minus the carry return. How much cost we are incurring for this option or the future contract, and what is the spot price today, and how much return we are going to get it from this. That is basically the price of the forward or the future. That is the basic fundamental or theoretical model what we can establish, or theoretical logic what we can establish for pricing of the future. So, here the carry cost means what? It may be holding cost, it may be interest charges on borrowings, insurance cost. If it is commodity derivatives, then it can be considered as the storage cost and all these things. Then we have the carry return. The carry return is nothing but the income what basically we are expecting from this. It may be dividends, it may be any kind of cash flow what we can get it from that particular asset or particular instrument or the underlying asset. So, that is the way basically the carry pricing model works. So, this is the theoretical understanding, but how exactly this carry pricing model works in the practical sense, that we have to see in the actual sense how it is worked. So, here we can observe that we have the different type of assets always we get, different type of instruments, underlying instruments we have, on on that basis the future contracts are designed. So, you have the different kind of assets are available in the market, or we are designing these future contracts on the basis of the different type of assets. How the different assets are defined or different assets are classified. The different assets are classified. There are some assets they provide no income. In between you do not generate any income out of this, and there are some assets they provide certain income which is given, a fixed amount of dividend or fixed amount of return periodically you are getting from that asset. And another kind of asset where the amount is not fixed, or they know that how much yield they can get, the return percentage is given, percentage of certain kind of value will be given to you. So, this is the way the particular kind of assets are classified. Then whenever you calculate the future price of those assets, that future price of those assets depends upon the nature of the particular cash flow what you are getting, or the nature of asset whatever we have. So, that is the way the pricing of the future contracts are made or forward contracts are made. For example, you see the securities which provide no income. If there is a security which provides no income, then how the pricing of this particular security can be made? It is simple. Let here in the derivatives whenever we take, always remember we consider the return is always a risk free rate of return, that basically you can keep in the mind. So, let the spot price is S and the future price is F, and the contract is deliverable in year t, then your f is equal to s into 1 plus r to the power t. That is why in the normal market we assume that the future price is more than the spot price. The future price is more than the spot price. So, for example, you are here the t is equal to 2 and r is equal to the risk free rate of return, which let in our case we have taken the 7%. Let the r is equal to your risk free rate, if your risk free rate is the r, then which is 7%, that means 0.07, then s is equal to let 300, t is equal to 2 years, r is equal to 7%, then f is equal to 300 into 1.07 to the power 2, that will give you 343.47. The future price will be 343.47. You remember here this asset is not giving you any kind of income in between. Directly we are calculating with respect to the period of maturity, that is the 2 years. But there is another asset which is giving you okay, we will see that here we are talking about another concept. Let particular interest rate is compounded. If the interest rate is compounded, then your f is equal to s e to the power r t. Here we have taken s 1 plus r to the power t, but here if the interest rates are measured with continuous compounding, then we have to consider your future price is equal to spot price e to the power r t. And here already I told you that provides no income, no storage cost, that is the assumption whatever we have taken. Let we have s is equal to 50, r is equal to 7%, t is equal to let 6 months, that means 0.5 years, then f is equal to 50 e to the power 0.07 into 0.5, that you got it 51.78. But here two things you can observe. Let you find that f is greater than s e to the power r t, then what will happen? If f is greater than s e to the power r t, then what the investor can do? That means the future price is more than the spot price. The investor at the time of maturity, the investor may buy the asset now by borrowing an amount equal to s for a period of t at the risk free rate of return and take a short position in the forward contract. Short position in the sense he has sold the forward contract. He has sold the forward contract and bought the underlying asset today. Let for buying that asset does not have the money, then what he can do? He has borrowed that money. So, at the time of maturity, what will happen? The asset will be delivered for a price of f. He has sold it, he got the price, and the amount whatever he has borrowed, that will be s e to the power r t. Then obviously, the profit he can earn, that is f minus s e to the power r t. The borrowed amount is s, interest is compounded, then how much money he will repay? He will repay s e to the power r t, but already he has taken a selling position, short position in the future market. That is why the contract will be matured, he will get back his price on that particular day and he will get f, and if f is greater than s e to the power r t, then even if he has borrowed that money at a rate of interest of which is 7% in this case risk free rate of return, then what he can do? He can generate a profit of f minus s e to the power r t. It can be reverse also. If f is less than s e to the power r t, then what the investor can do? He would short the asset, he will sell the asset, invest the proceeds for the time period t with the interest rate r and buy the long period contract this is basically rate, there is a typo error, this is rate. And when the contract matures, the asset would be purchased for a price of f, and the short position in the asset would be closed out, and finally, the profit he can generate, that is s e to the power r t minus f. So, if at any point of time this particular condition does not hold, f is equal to s e to the power r t does not hold, then there is a chance of profit generation at the time of maturity. That means, the investor can create certain profit if the identity between the of the condition like f is equal to s e to the power r t does not hold. That basically we have to keep in the mind. Then we can see that other type of securities. We discussed about a security which does not provide any income. Let there is another security which is giving a known income. Let you assume preference shares. You know preference shares which provides the certain amount of income periodically, certain amount of dividends periodically, which is known to you. Then how the formula basically looks like? Here f is equal to s minus I e to the power t. Remember, we are all now using it in a continuous compounding case in this case. And what is I? I is nothing but the present value of the income received from the asset for that particular period. If your s is equal to 50, r is equal to 7%, t is equal to 0.5, let your I is 5, present value of this particular cash flow what you are getting from that particular security in that particular period, let that is 5, then your f is equal to 46.6. That means, that has to be deducted. You remember that in the carry forward model, whatever we have seen, we have to the cost underlying asset price has to be deducted, the cost what you are incurring, that is the payment what you are making in terms of the dividends. So, that is why s minus I e to the power r t, then you can get the future price of that particular contract. If it is a known yield, let the investment asset provides a known yield in terms of absolute value, they are giving certain interest, certain kind of rate of return with a certain percentage. Then here basically let the stocks with paying dividends a certain percentage, futures or forwards on currencies like foreign risk free rate. If you are taking, then how basically you can calculate the price of that particular contract. In the same example, if your y is equal to 0.03, then basically this formula will be this, your f is equal to s e to the power r minus y t. The r minus y is basically the part, the yield, or the if it is a forwards for the currencies and all, this is foreign risk free rate. So, here y is equal to 0.3 if it is given, then you can find out 50 e to the power 0.07 minus 0.03 into 0.505 is equal to 51.01. So, this is basically happening of a particular asset where the asset provides a known yield. Then we can see that what are those other things related to this. So, now what we have seen, if f should be equal to s e to the power r minus y t. If there is a differences, either f is less than s e to the power r minus y t or f is greater than s e r minus y to the power y t or f less than, does not matter, then there is a chance of arbitrage. Then how the arbitrage then works? Then when f greater than s e to the power r minus y t, then what the arbitrager can do? The arbitrager can buy the stocks and sell the future, and when f is less than the s e to the power r minus y t, then the arbitrager can buy the future and sell the stocks underlying the index. This particular arbitrage involves the simultaneous trades in futures and many different stocks in the market. So, let us see that how basically it works. So, whenever we are talking about this arbitrage opportunity, already we have seen that if that identity does not hold good, then this kind of thing can be possible by taking the different positions in the market. Then if it is a consumption assets, let it is a commodity, then what basically you can do? You can go for let us see is the storage cost per unit, then your F is equal to S E R plus C T, C is the storage cost for the unit, or you can find out F is equal to S plus T, S plus C e to the power R T, and C is the present value of the storage cost over the period of time. So, in case of Y, we are taking the C, which is per unit storage cost, or here C is nothing but the cost what we are incurring for the over a period of time, and we are calculating the present value of that. Then if you are going for a valuing the period future forward contract, then if the K is the delivery price and F is the forward price, then value of the long forward contract is let F minus K e to the power R T minus R T, and the value of the short forward contract is F is equal to K minus F 0 e to the power minus R T, and here K is equal to the delivery price and F is equal to the forward price. That is the way the valuation of the forward contract is done. It is F minus K e to the power minus R T, and or if it is a short forward contract, then it is K minus F e to the power minus R T. Then if you talk about the option prices, there are many factors which affect the option prices. Here the future prices are mostly affected by the cash flow and as well as the delivery price of that particular contract and as well as the time period and the risk-free rate. And here the option prices also is driven by the spot price of the contract, the strike price of the contract, the time period, risk-free rate of return, then you have the volatility of the price, that is sigma, and another one the dividend or any other income what you can get it from the underlying asset in that particular period of time. What kind of relationship we can expect between these fundamentals with option prices? If the spot price increases, that means the market price increases, then the price of the call option will increase. That already we have seen, that option will be exercised and the payoffs will be positive, then the price also of the option will increase. But if it is a put option, the price will be negative or price will be declining. So, there is a positive relationship or direct relationship between the call option price with this spot price of the particular asset or the market price of the particular asset, and if it is a put option, there is an inverse relationship between these two. But if it is a strike price, then obviously if the strike price is more, then it has a positive impact on the put option and it will have a inverse impact on the call option pricing, because for the put option the payoff is always decided on the basis of K minus S, and in case of call it is S minus K. So, keeping that thing in the mind, we have a negative relationship with call and positive relationship with put, which is just reverse relationship what we expect for the spot price or underlying assets price. Then we have time to maturity. If the time to maturity or time period increases, then obviously the price of both type of options will increase. So, that is why we can have a positive relationship for the both. Then you have risk-free rate. This is basically also is used as a discount rate. So, that will have a positive impact on call and negative impact on the put. And if it is fluctuations or standard deviation, then it will more the standard deviation or more the fluctuations, of the pricing of the spot pricing, it will have positive impact on the option pricing, because more the volatility, the risk will be more. So, depending upon that, the premium also will be more. So, dividend is basically we are deducting it from this. That is why if it is a call option, it will have a negative relationship. If it is a put option, it will have a positive relationship. So, these are the expected relationship what we can get it from the different kind of factors, or how the expected relationship can be established between the different fundamentals or the factors with respect to the pricing of the options. Then we will see that how basically this particular concept works in the market in the future. So, here you see for the option prices, we have some upper bounds, you have some lower bounds. How much the option prices can be maximum and how much the option prices can be the minimum. So, if an option price is above the upper bound or below the lower bound, then there are profitable opportunities for the arbitrageurs, that always we see, and we will see that how this particular arbitrage opportunity can be possible. Let there is a upper bound for the call option, how much maximum the call option price may be, either it is a European option or it is American option. That small c represents European option and capital C represents the American option. For both the cases, the maximum call option price will be the price of the underlying asset, the price of the underlying asset. So, either C will be less than the underlying assets price, or it can be equal to the underlying assets price, it cannot be go beyond that. So, if this relationship does not hold good, then the arbitrageurs can easily make the riskless profit by buying this stock and selling the call option. For upper bound for the put option, it can go maximum to the strike price. The put option price either less than or equal to K for both American and European options. If this is not true, or for if it is it is not true, then riskless profit can be made by writing the option or by selling the option and investing the proceeds, whatever money you can get it of the sale of the risk free interest rate. Let us see how that particular concept works. If you take this example, let there is a lower bound for call option, non-dividend paying stocks. The call option is basically what you have C greater than or equal to S minus K to the power R T, that is the lower bound. Let example is C is equal to 3 rupees, T is equal to 1 year, K is equal to 18, S is equal to 20, R is equal to 10%, no dividend, let no dividend paying stocks we have taken. So, is there any arbitrage opportunity? The lower bound is basically C is greater than or equal to S minus K to the power minus R T, that is the call option case. Then what they can do? The arbitrager can buy the call, S 0 minus K to the power R T, if you can calculate, that has come 3.71. The arbitrager can buy the call and short the stock, and the inflow will be your 20 minus 3, that is 17. Then invest for 1 year at 10% per annum, then how much you are getting? 17 e to the power 0.1, that is 18.78, because the T is equal to 1. Then if the stock price is greater than 18, K is equal to strike price is 18. If the stock price is greater than 18, then he can exercise the option to buy the stock and close the short position, and the profit will be 18.79 minus 18, that is 0.79. So, that 0.79 what we consider, that is a riskless profit what he can earn from this. For example, for a put option, the P is greater than are equal to k e to the power minus r t minus s. So, if that is the case, then if you take this example, you can see how this particular arbitrage profit is possible. P is equal to 1, we have taken, suppose S is equal to 37, T is equal to let us 6 months 0.5, R is equal to 5%, K is equal to 40, and we have taken D is equal to 0. You can calculate k to the power minus r t minus s, that is 2.01. It is more than the put price, P is equal to 1. Then what the arbitrageurs can do, can borrow 38 rupees for 6 months to buy both put and stock S 37 plus 1. Then how much he required to pay? He required to pay 38 e to the power 0.05 into 0.0 into 5 is equal to 38.96, and if the stock price is below 40, then the arbitrager exercise the option to sell the stock for 40 rupees and repay the loan and makes a profit of 40 minus 38.96, that is 1.04 rupees. So, that is the arbitrage profit what they can generate out of this. So, that is why you have for call option case, it should be, if it is a dividend paid, then the condition should be S minus D minus k to the power r t for call option. For a put option, it should be D plus k to the power minus r t minus S. That actually you can keep in the mind. Then we have another condition, there is a put call parity. If you know the put price, you can find out the call price. If you know the call price, you can find out the put price. So, that is the put call parity condition, C plus k to the power minus r t is equal to P plus S. C is equal to the call option, k is equal to strike price, P is equal to the put price, S is equal to the spot price. And if that condition does not satisfy, then there is a chance of arbitrage. And how it is? Let C is equal to 3, S is equal to 31, T is equal to 0.25, R is equal to 10%, K is equal to 30, and D is equal to 0. What are the arbitrage possibilities when P is equal to 2.25? Let this is the question. Then if you want to see, then what you can find out, because this condition has to be satisfied. C plus k to the power minus r t is equal to P plus S. Then C is equal to 3, k is equal to 30, e to the power r is equal to 10%, t is equal to 0.25, 3 by 12, then you can get that 32.26, and P plus S is equal to, P is equal to 2.25, S is equal to 31, S is equal to 31 and it is 2.25, then you get 33.25. So, what is the arbitrage strategy you can create? Buy the call, short both put and stock, and how much cash flow you can generate, that is minus 3. Buy call means you have paid 3 rupees, which is the premium for the call option, then plus 2.25 plus 31, then your cash flow will be 30.25. Then invest that 30.25 at a risk free rate of return, you get 31.02. And if the stock price at expiration of option is greater than 30, the call will be exercised, and if it is less than 30, then the put will be exercised. In either of the cases, the net profit will be 31.02 minus 30 is equal to 1.02. So, then that means what we have seen, that if this condition does not satisfy, in both the cases the arbitrage opportunity exists. So, that is why we have to always ensure to not to create an arbitrage opportunity, the put call parity condition should hold. These are the references what you have to follow for this session, and another thing you keep in the mind, in the future sessions we will be discussing about the different models used for the option pricing, like your binomial tree model and the Black-Scholes model. Then we can move into the discussion on the swap. Then finally, we will discuss about the developments which have happened in the derivatives market with respect to India. Thank you.